We're at the Youth Inc. State of the Markets Conference in Midtown Manhattan, and we are joined today by Larry Schloss, Deputy Comptroller for Pensions and CIO for the City of New York. He's going to be speaking to us today about where he still sees opportunities in VC and also where secondary activity could be heating up the most. You once spun a private equity firm out of an investment bank. We're still seeing more come to market. If you could give them any advice, what would you say?
Well, I think the key to leaving an investment bank as a team is to be able to keep the culture that you had at the old place, but create your own culture at the new place. Because again, you're sort of being liberated, if you will, from the mothership. It's very, very different when you go out on your own. Part of the reason it's different is because you don't have the same deal flow, perhaps, that you had before. So you need to prove to investors that you can make it on your own, because what you've done is you've left let's call it the mothership, and you've sort of launched yourself into the ocean of private equity firms that already are set up, and they really are ahead of you. So I would tell you, so the first fund is really, really the most critical. I would actually say, don't worry so much about the size. Don't spend a lot of time figure out how much time you want to spend fundraising. Get started, get investing, and the rest will take care of itself, assuming that the returns are there.
All right. Sounds like pretty sage advice, or at least for some of the folks who are also going to be coming out. One of the things that I've kind of spoken to LPs about, some of my sources over the years, is that the secondaries market keeps growing, and right now it seems like the bid-ask spread has been narrowing a little bit. Would you say that you're a buyer or a seller right now?
Well, we're sort of both. We have, let me do some quick math. We have somewhere between $1 billion and $2 billion of commitments to secondary funds. So they're buyers. Having said that, last year we sold $1 billion worth of secondaries ourselves at attractive prices. It was all done through auctions with an agent. So again, we were trying to manage our portfolio. We had 168 funds and 110 GP relationships, and it was just too much. So we needed to do some repositioning of our portfolio like any seller would. We did. Some of the stuff didn't clear the market at prices that we thought were reasonable, so we kept them. I would tell you that every large institutional investor should be a seller on a regular basis, regular being every couple of years, if you will, to retool their relationships with GPs, to redefine their funds. At the same time, having said that, because what's called a portfolio management technique, at the same time I think that investing in secondaries is a great investment in and of itself, because it's a pool, you're further down the J curve, the cash comes back quicker, the variance of outcomes is much tighter. If you pick the right managers, you should reasonably do in the double-digit returns, and it's private equity. So I just think it's a great portfolio management tool, and it's a great investment as well.
And you mentioned portfolio management and rebalancing, and it seems like one of kind of the themes that has come up is public pensions that have been backing away, most notably CalPERS, from venture capital. Are you still a buyer?
We decided strategically about 2 years ago to de-emphasize venture capital. The problem with venture capital, besides our returns as we defined our venture capital portfolio, weren't very good. We need to make double-digit returns in our private equity portfolio to make our asset allocation work. And that works if you get into the top decile venture capital funds. And we weren't in the top decile funds. And if you do get into the top decile funds, they take very, very little amounts of your money. When you have $135 billion, making a $10 million commitment to anything is really a waste of time. So it doesn't really fit our agenda because we have so much capital, and I think that that's a problem with large public pension funds and venture capital.
All right. As an LP, when you now, and as somebody who's already raised a fund and has now transitioned out of that, what are some of maybe the red flags that pop up to you when you see other GPs out fundraising?
I think the most complicated part of analyzing a private equity fund, because the numbers are very straightforward, is personnel turnover. It could be the highest levels, which is the most complicated, or the junior levels, because if we've seen some funds where the senior guys stay together, but they just plow through the junior people. that's not a good sign, because really private equity is a team sport, and it's a culture sport, and it accrues over decades.
Right.
So you have to get that right. You have to build a great firm. A fund is just a financing vehicle. But it's really, when you cut through it, we really invest in the firm of GPs. Because again, a fund life is 12, 13, 14, 15 years. The odds are reasonable that the people that were there at the beginning aren't there at the end. You need to be very, very sure that the firm is viable, the concept is viable, they can continue to refinance themselves, and whatever theories you invested in are the same that go throughout that period of time. So I think the most complicated funds that we go through are ones that had high or some amount of personnel turnover, particularly if the people's names are on the door. So I would also give a piece of advice to those people who were spun out, going back to your first question, don't put your names on the door.
And you didn't at Diamond Castle,
we
and I
didn't.
appreciate you joining us today. Thank you very much.
Thank you. Glad to have done it.